For 2026, Chicago's real estate market presents a strange contradiction we are about to unravel. Despite a stable market, foreclosure filings are expected to keep climbing through the entire year. This isn't a market crash. It's the delayed financial shockwave from the end of pandemic-era protections. Yet at the same time, most analysts agree that Chicago's property market will see continued growth. So how can both be true? We'll break down the market's foundation, expose the hidden pressures, and show you what it means for 2026. First, let's establish the foundation. What does a stabilizing Chicago market actually look like? It's a return to normal after years of volatility. Top economists from Fannie Mae, the Mortgage Bankers Association, and the National Association of Realtors all share this outlook. NAR's chief economist, Lawrence Yun, is even more optimistic, predicting a potential 14% rebound in existing home sales nationally as rates ease. This stability translates directly to your home's value. Projections show Chicago property prices increasing by 2.5 to 4.5%. And this isn't just a city phenomenon. Suburban markets are also expected to see steady 3 to 5% annual appreciation. But this creates a major question. If prices are rising and sales are growing, why are more homeowners facing foreclosure? The answer is coming up. The answer isn't a weak market, but the rising cost of keeping a home. This is a story of increasing financial pressure on existing homeowners. Let's break down these pressures. First, surging home insurance premiums are hitting budgets hard. Second, high interest rates affect anyone with variable rate debt. Third, climbing HOA fees add another layer of non-negotiable monthly expense. These factors combine, squeezing finances even if a property's value is rising. This financial squeeze is colliding with a major policy shift. Pandemic-era moratoria paused many foreclosure proceedings, creating a significant backlog. Now, that backlog is hitting the courts. By late 2025, Illinois was already seeing one foreclosure filing for every 25 and 70 homes, a trend set to continue. So we have two opposing forces, a solid growth story and a painful cost of ownership story. How do they play out across Chicago's diverse areas? In the city's core, we see major investments in infrastructure, which is creating sustainable demand from buyers. Out in suburbs like Naperville, appreciation is strong, fueled by corporate relocations and remote work flexibility. Underlying this is population growth. Chicago's job market continues to draw people in, increasing housing demand. And for those not buying, the rental market is expected to stay incredibly strong, thanks to a surge of millennial and Gen Z renters. This broad strength is undeniable. But a closer look at the market data reveals a more complex and nuanced picture. After years of tight supply, inventory levels are finally starting to normalize. This suggests the market is moving toward a healthier balance. What this means for transactions is that buyers might gain slightly more power than they've had in years, especially in the mid-range market. However, do not mistake balance for slump. Homes are still expected to sell at a steady pace, averaging just 30 to 35 days on the market. So here's the true paradox of 2026. A market balanced enough for steady sales and price growth, yet with rising costs pushing some owners to the brink. So what is the unified theory that explains this all? How do we connect these dots for homeowners, buyers, and investors? The key is understanding that the stabilizing market isn't lifting all boats equally. The rising ownership costs we detailed earlier hit a specific group. This includes those on fixed incomes, owners with adjustable rate mortgages, or those who bought at peak prices with minimal equity. For them, rising costs erase gains. Therefore, our 2026 forecast isn't for a market-wide foreclosure crisis. It's for a targeted increase in foreclosures among the most vulnerable homeowners. This creates a dual-track market. For most, it's stable appreciation. But for savvy investors, these pockets of distress present distinct opportunities. Let's recap the forecast for Chicago in 2026. We have a healthy, growing real estate market operating alongside a rise in foreclosure activity. This isn't driven by a crash, but by a post-pandemic cost of ownership squeeze on vulnerable households. The outlook is one of nuance. Expect overall market stability, but with emerging pockets of distress. This creates different challenges and opportunities. For homeowners, this is a call for financial vigilance. For buyers and investors, it's a signal for strategic action. The key is understanding this paradox.